Our next paper presenter is a highly accomplished financial expert with over 20 years of experience in investment banking, asset management, and capital markets. He is the Group Managing Director of Meristem Security Limited, a leading investment firm in Nigeria, a position that he assumed in January 2025. Prior to this, he served as Deputy Group Managing Director for over a decade and has been Managing Director of Meristem Wealth Management Limited since August 2008. He has a Bachelor of Science in Banking and Finance from Olabisi Onabanjo University, where he graduated with a second-class upper. His academic foundation in accounting was established at Ondo State Polytechnic, earning a higher national diploma with distinction. To enhance his leadership expert, he completed the General Management Program at the Harvard Business School in 2011. As a chartered financial analyst since 2013, he is recognized for his deep expertise in wealth management, portfolio strategy, and investment strategy. He is also an associate of the Chartered Institute of Accountants of Nigeria since 1998, a dealing clerk on the Nigerian Stock Exchange, a fellow of the Chartered Institute of Stockbrokers, and associate member of the Chartered Institute of Taxation. He plays a pivotal role in corporate governance and financial strategy across various industries, the board chair of Transnational Express PLC, Lekki Mills Limited, and Carnation Registered, formerly known as the Main Street Registrar Limited, and served as the director on the board of Afri Global Insurance Broker, contributing to growth and innovation in Nigerian financial and corporate sector. With an extensive background in capital markets, financial advisory, and risk management, he has shaped Nigerian investment landscape. His leadership at Meristem Security Limited has been instrumental to driving wealth creation, investment planning, and capital market development. Outside professional activity, he likes to play golf and reading and also traveling. Ladies and gentlemen, let's welcome Mr. Sulaiman Adedokun. He is not going to be presenting his paper today, so that you don't commit an offense. He's not going to present the paper. He has sent a high delegation here to us, and to present his paper to us is the MD of Meristem's Stockbrokers, Mr. I have your own name too here. What happened to mine?
Saheed Bashir.
Okay, you want to save me, right? My sister just shut down. Let's welcome Mr. Saheed Balogun to take the
Thank you, MC. I think the MC just revealed one of the secrets about him now. I think you watch Nollywood a lot. You mentioned Saheed Balogun, right? Mine is Saheed Bashir. It's fine. Thank you.
That should not go beyond this room.
No, it's a thriving industry anyway, and they also pay tax, I want to believe. Exactly. So, thank you so much. I want to, good afternoon, ladies and gentlemen, and my sincere appreciation to the organizers of this workshop and seminar. And I'll say to the distinguished guests, as well other speakers who have spoken, and of course the SEC DG ably represented by Mr. John Briggs, and the other invited guests seated, as well as the rest of the audience. And I would also also recognize our dean, I'm also a member of the Institute of Digital Accountants, so I'm doyen, and the other doyens in the house. You are most welcome. And I'm not the group managing director of Maritime Securities Limited. As the MC was reading his profile, the last thing he said is that what he enjoys most, he enjoys playing golf, reading, and traveling. So one of those things he enjoys most is traveling. So eventually he's not around, he traveled. So that is why he's not able to make it. So I will try as much as possible to deliver, not essentially in paper. I'm not sure it qualifies as a paper compared to what the taxman himself has done. So I would say it's just perspective about the new tax laws in terms of operational, how it affects our domain, the capital markets. And our regulator is here. So we are operators, just like my colleague seated there top there. We are operators affected by the new tax laws. So how does it affect us? What are the perspectives that we have on the new tax laws, and what are we bracing up for ahead of 2026? So those are the perspectives that we'll be sharing today. And don't worry, I won't bore you. Unlike, of course, it wasn't boring anyway. It was we all enjoyed it, but it is not paper as it did. It's perspective. How is being projected? Okay, so the impact of the new tax reforms on the capital markets, both for the foreign investors as well as the local investors. What are the impacts? A lot has been said, and it makes my job easier, or not my job anyway, because it's not my presentation. I'm just reading what my boss would have presented, our GMD. Okay, so it's coming up, I was told. Essentially is the overview of the four tax acts, which is expected to be operationalized in 2026. Of course, as earlier mentioned, as we have also read severally, is about stimulating growth, generating more tax revenues for the government at all levels, not only at the federal levels, but at all levels, both national and subnational. And of course, to strengthen the tax administration in Nigeria. I think that is essentially, if we summarize, what the new tax laws are meant to do. And talking about institutional reforms or institutional transformation, apart from the nomenclature, change in nomenclature, we have Federal Inland Revenue Service, now Nigerian Revenue Service, right? Possibly, maybe we would also have state internal revenue service, as the case may be. But we have NRS instead of FIRS. That is a change in nomenclature and possibly identity. We don't know what to come in terms of other identity or change of identity to come. Yes, the new tax law also talks about increase in operational coverage. They want to widen, or talks about widening the tax net to cover more people, to bring more taxpayers into the net. That also widens the tax revenue, or increases the tax revenue for the government. And essentially, which everybody has mentioned, is strengthening the institutional capacities across board, both for the taxman and also the taxpayers, because we are talking about digital innovation, or the taxman will be deploying a digital infrastructure to improve on tax collection, which also means that, of course, there will be initial challenges, which is one of those things that we have seen from the operators in the capital market. And I believe it's not only capital market, across board. You are deploying sophisticated technology to ensure that you increase compliance and also improve transparency in the way tax laws are administered. Of course, there may be some initial challenges with respect to how does your technology, your infrastructure, talk to the infrastructure of the technology of the operators, I mean the taxpayers, most especially in the capital market. We are at different levels in terms of technology adoption in the capital market. So that would be the areas, one of the challenges I would pose to the taxpayers on this side. And of course, a lot more in terms of infrastructure. We have to deploy more infrastructure to in terms of the way we operate at the back end. And not only that, also educational knowledge. We need to also brace up in terms of the human capital to ensure that they are up to the task with respect to the implementation of the new tax laws. These are the institutional capacities in terms of the strengthening of institutional capacities that we would expect from the implementation of these tax laws that we are talking about. And talking about tax simplification, yes, as earlier mentioned, by previous speakers, most especially by Doctor in his presentation, as a tax man on the earlier presentation, he made mention of for the development levy, instead of having multiplicity of tax, police fund, NITDA, and the rest of it, everything has been consolidated. We have 4% on the development fee. That makes it much easier, and you can avoid the headache that comes with the multiplicity of different taxes in that regard. Then in terms of compliance, improve compliance mandates, we also expect that would up our game in the capital market to ensure that we comply. I think looking at the entire tax laws and the new changes in the tax laws, what is glaring and which people have been talking about is the capital gain tax, CGT, from 10% to 30%. What does that imply for the market? It implies a lot. Of course, there's minimum tax, as you have mentioned. It's two ways. For the retail investors, it's a win for the retail investors. Most likely, it's going to improve and increase participation in the capital market, most especially at the bottom of the ladder. For the we have more retail investors coming to the market, and that speaks volume as well. It's a win for the market. Why did I say so? For those of us who remember so well, in 2007, 2008, when we had the global financial crisis, and market was, from its peak, it came to its nil, and we lost quite a number of investors, Nigerian investors in the market. Subsequently, when the storm was over and everything was calm, we saw a lot of foreign participation in the Nigerian market. And we had recession subsequently. I think sometime around 2013 or thereabouts. And when the foreign investors left, we felt it, we the operators in the market, we felt it. Because the foreign investors were controlling 70-80% in terms of participation. Once they leave the market, when they are selling, everybody is selling. That fear grips the market. But that balance changed afterwards, and you could now see the reversal of the ratio. You see more domestic and local participation. You can see 68, sometimes at 80, came down to about 70-30, meaning that you now have more Nigerians, both at the retail level, institutional level, and ultra-HNI and HNI, more participation in the market, and that helps to stabilize the market. Even when foreign guys are selling, we don't feel it as much as we used to feel it, and that tells you why it is important, why retail participation or more domestic participation in the market has a lot of impact. So I would say that the CGT from 10 to 30% for the retail investors is a win for the market. However, for the non-retail investor, it will not be a win, at least in the interim. because what used to be 10% now harmonized at 30% together with, which is more or less equivalent to the the company income tax at 30%. That is taking more liquidity or taking more from you when you dispose your shares, except you reinvest such money. So the discussion in the market is that may affect market liquidity. What do I mean? So the frequency of transactions in the market will be affected in the short run, because you buy, you sell, and you make your money. So perhaps people want to take a breather and understand how does the new tax law affect them when they dispose of their shares in the market, and that may slow the frequency of transactions in the market. We are not going to be happy as operators in the capital market, but as I said, everybody is trying to look at it. How best can you plan your tax? Tax planning is not a crime. It is what is even expected, and that is what people like TAC affirm what they do. They help you in tax planning. So that means that you need to get experts to help you to plan your tax, to take the best advantage of the loopholes in the tax law. Because tax laws are not holy books. The tax laws, there will be, whichever way it is implemented, there will be ways you can minimize your exposure without breaking the laws. And that is why you have professionals that we are going to work with. And so I'm sure that Ogada Ramoja is quite happy, and his team and the rest of professionals in this field, because they would have a lot on their hand to grapple with in terms of working with operators in the capital market to ensure that they better plan their tax in that regard. Of course, as it affects, I'm still talking about the capital gains tax. For individuals, of course, in terms of payees, even at the level of payees, it is still a win for the retail investors because of the minimum tax now, because of the changes in the pay structure. If you earn below 800,000 naira, right, you are still good, and of course that is still at very retail level. So meaning that you have more disposable income to put into investment and savings, and that is also a plus for the capital market. So whichever way you look at it, whether from not being taxed at 30% on capital gain tax, and that gives you additional room, you can invest more money and the rest of it. So that is a plus for the market in terms of the retail investors. Is a win for the retail investors, but for the non-retail investors, it is going to take more money from them, and it may also affect market liquidity, the volume of transactions in the market. But as I said earlier on, now depends, that makes everybody to sit down and look at how best can we take advantage of the tax laws and the loopholes in the laws to ensure that we can do proper tax plannings and get the best out of it. Then the development levy, which I mentioned earlier on, is now consolidated at 4%, and 4% on development levy for the accessible profit. And of course, if you look at whichever way you look at it for tax, for companies quoted either for capital market operators or for the companies quoted on the exchange, companies that will trade their shares, tax is a disincentive in one way if you look at it, because you as an investor, the more tax the company pays, reduces their bottom line, because what comes to you is a dividend apart from the capital appreciation. So the dividend that is payable to you as an investor may likely reduce. But of course, as I earlier mentioned as well, compliance, transparency, and there may be initial pains, and people will take advantage and looking at how can they better structure their books and plan their tax to make the best out of the tax laws. And there is an issue of the minimum tax, which has been discussed widely today. Yes, implementation of 15% minimum tax, and the CFC rule. The CFC rule is the Controlled Foreign company tax rules, which I think is aligning with global best practice. That so you must. We can compute minimum tax. What is the tax you pay relative to the your profit, accounting profit? If the minimum tax, if your minimum tax computed by the amount of tax you pay relative to your profit is less than 15%, meaning that there will be top-up tax. That is the provision in the new provision in the law, that you pay the minimum tax is now 15%. If they compute your tax, so the tax authority, they have, they are empowered by the new tax laws to ensure that you don't pay below the minimum tax. And when there is an instance that a firm pays below minimum tax, the taxman is empowered to ensure that you are brought to the minimum, which is 15%. Of course, that is also maybe a disincentive in the way, kind of for companies in the market, in the capital market, because as I said, for investors, what comes to investors, you profit from the capital market in two ways. The first way is by the virtue of the dividend that comes to you. The second way is the capital appreciation. Some investors category, they place a lot of premium. In fact, the Nigerian market, as a matter of fact, is a dividend sensitive market. Any company that does well that doesn't pay dividend, market punishes such a company. So that is why dividend paying is a big thing in the Nigerian market. So any form of tax that affects the bottom line, because it is the bottom line that determines the dividend that the company pays, that may disrupt, or that may, investors will usually frown at such a thing, as the case may be. In terms of the CFC rule, which is the Controlled Foreign Company Rule, what that means is that we have Nigerian companies that have more than 50% ownership of a foreign company in other jurisdictions, maybe in tax havens, and they are not in Nigeria, but they are doing so well and they make profit. The new law now makes provision and empowers the taxman to levy tax on such companies, and even to the extent of if they distribute dividend and the rest of it, they can further tax such a company, even though it's not in Nigeria, and repatriate such income back to the coffer of the government. So that is those are part of the new changes that we will be seeing in the new tax laws. With respect to value-added tax, there is no change at all. I think in the bill there was a proposal from 7.5 to 12.5 or so, but I think that wasn't passed into law. So 7.5 is retained. I wonder if that had been done. It would have been so easy. There would have been a lot of noise moving VAT from 7.5 to 12.5. But let us enjoy 7.5 while it lasts. And even the capital market has not forgiven there was a waiver in the market up to 2019 when government waived, or not waived, there was a waiver of VAT on transaction. In any market, what makes market more efficient is when you have low transaction cost. Then it makes everybody want to participate more. You have more participation in the market. And most of the time, brokers like us, we are the receiving end. Because if you look at the breakdown of the commission table, broker can charge maximum of 1.35. In some transactions, we were discussing during the tea break, in some transactions that we do, sometimes we charge zero commission. Even though taxman will tell me that, no, I don't agree. How can you charge zero commission? That is a loss, revenue loss for the government. Taxman will disagree when they are doing my audit. That it's not possible that you charge zero commission, but because it's a marketing gimmick for me, I want to remain in the spotlight in terms of volume and volume of transactions on the exchange. Sometimes you do PFAs, they don't pay up to 0.2% commission on their transaction. Most of them pay 0.1, between 0.1 and 0.2%. So when they do billions of transactions, what comes to broker is very, very little in terms of commission. So, however, my regulator, I won't mention names so that I don't want to be sanctioned. 0.3 is still sacrosanct. Market infrastructure, CSCS 0.3%, NGX 0.3%. On top of that one, I still put VAT. I will charge VAT on brokerage commission. There will be VAT on CSCS. There will be VAT on NGX and all that. So if you look at all that, that makes, if you buy, the brokerage commission is around 1.8. No, sorry, the transaction charge is around 1.8%, 1.8, 1.9 when you buy. When you sell, is around 2% approximately. So you could imagine if there's no VAT. So we enjoyed that regime prior to 2019. That was, I think it was after the global financial crisis of 2008. I think there was a forbearance with the banks. AMCON came into place, and FGN and the federal government waived VAT on transaction, and just to encourage people to jumpstart the market again, and we enjoyed it. But as I said, we enjoyed it while it lasted up to 2019, but that has been reinstated. But we thank God that they didn't take it above 7.5 again, so that is still there. Then additional thing is that, which is also coming upon us, we're having new instruments in the market, digital assets, and it is becoming household name now. Before now, it's about buying stocks, buying commercial papers, treasury bills, and the rest of it. But the world is changing. Thanks to SEC, even when CBN was still playing catch-up game, SEC has worked on digital policy for the market, and it has become a law now. So the digital cryptocurrencies and digital assets are not outlawed. These are instruments that have also come to the market, and a lot of operators and even regulators organizing seminars, workshops, discussing about digital assets. But the bottom line is that digital assets are also not exempted again, because they are new asset class that has come into our domain. So they would also not be exempted. When you trade on digital assets and you make gains, there's also the capital gain tax on that. What are the implications? I've mentioned a couple of implications for this, but let me also mention more implications of the new tax laws on our market. I meant the CGT, the capital gain tax, and yes, no doubt about it, may delay profit taking. If I buy a stock, or my portfolio was, I brought in 500 billion to the market, and my capital my portfolio is now about 600 billion naira. Instead of taking my profit, maybe I want to delay it, because once I dispose of my portfolio, I'm going to pay 30% on the capital gains, as the case may be. So it may delay. I have two options. Either I delay exiting my position, number one, or I can exit my position and reinvest that money instead of taking it out of the capital market, which is also a good thing from the preparer of the laws. That yes, you can sell. Once you don't take the money away from the market, bring back the money to the market, reinvest the money, you won't be liable to capital gain tax. I think that's another way to look at it. But as I said, initially it may affect some level of liquidity in the market, but we shall see how things evolve. Retail investors, I've mentioned it, is a form of relief to the retail investors, and I think it's going to improve retail participation in the market. Transparency, yeah, we have mentioned transparency. Then, of course, it also prevents the controlled foreign company rule, which I mentioned earlier on. Also speaks to 15% minimum tax. It prevents offshore profit shifting. Instead of companies shifting profit to their offshore subsidiary, now even if you do so, they will bring it back because they can be taxed, and government is looking at you. Then, as per debt market and equity market, yeah, the first two speakers spoke. The DG of SEC presentation speaks to how the new tax laws would improve IPOs, because there is a ceiling in terms of interest, that there is a cap on interest that you can use as waivers when you have exposure to debt. And in that case, it may make equity more attractive to companies instead of raising debt, because except for government-backed securities, FGN bonds rather, or FGN securities generally, that are tax exempt. Others that are not tax exempt may be much more expensive relative to raising equity capital in the market. So that would be an advantage for capital market, instead of taking transactions to other markets apart from equities markets. So we have more transactions. A company we want to explore equity participation, IPO, public offers, as well as rights issue when you want to raise funds, instead of exploring a debt instrument, as the case may be. Innovation for market solution, yes. For that also makes the advisory services in the capital market looking at what best advantage, what is best for their client in terms of structuring of deals in the market. If a company wants to raise money, you need to check your models and look at what is the best mix in terms of capital raise. Is it more of debt or hybrid, as the case may be? Which one gives the best advantage in terms of tax? These are the areas that our capital market operators will be looking at when we advise our clients as regards taking position in the market or raising funds through capital market. I've mentioned trading cost. Yes, it may be a disincentive because the more elevated the tax, when you apply, you have transaction cost already, you layer it with VAT, and that increases transaction cost, and it affects break-even point or the break-even price of an investor, and that may reduce the level of liquidity in the market. But it is for us to look at what advantage can we take of that in the market. Then, for price discovery, when you want to discover price in the market, price discovery, I can interpret that to mean a particular stock is trading at a particular price. So, what is the best price to sell or to buy? That is a function of what is my profit or my likely loss, as the case may be. And that also comes down to transaction cost. If transaction cost is minimal, it helps in price discovery. The higher the transaction cost, the more difficult it is to discover price in the market. It makes price discovery much more difficult. Market activity tends to be slower than expected. Yes, let me quickly round up. For the market benefit and growth opportunities for the operators in the market, I've spoken about retail investors, what opportunities are available to the retail investors. Then, in terms of let me jump to my summary and final thoughts on the new tax laws. The Nigerian tax reforms are overall, and it is a welcome development, no doubt about it. And the capital market is poised to support it. We don't even have choice, and we believe that it's going to be positive for the capital market. But in terms of execution, we pose some challenges, as I've mentioned earlier on. Because if you look at in terms of from the operator's side, and that is where I would also key into the last 5 points that were raised during the DG's presentation. 5 points were raised. And one of the points raised with respect, apart from the IPO and equities in the primary market, the other side is the investors' education and stakeholders' engagement. It is very important. Apart from the other big firms, the big corporate firms that have competence and competencies in terms of, they have enough team in terms of advisory team for tax laws, implementing the tax laws. There are small operators in the market that do not have the capacity or the infrastructure, and they are still looking at how does the implementation of the new tax law, how will it affect either their operation or their client. I think a lot of awareness we need to raise in that respect. There must be increased awareness, and I think this particular session, this workshop is serving that purpose as well. We need more of such to ensure that we have more investors education, both for the operators and for the investors in the market, as well as other companies quoted on the exchange. Overall, it's a new dawn, and the market is going to be better for the new tax laws. Thank you so much.